Hey YouTube, it's Dimitri, and today we're going to cover securitizations from a quant modeling perspective, as I think the goal, the structure, the design is often not fully understood from the non-technical side that's doing the securitization, because, just do this model, just create this, and then the quant side tends to think it's very complex. And a different goal, which you'll see here, it's not to actually maximize accuracy. And then you have securitization agencies and banks and stuff that do a lot of this work on their own. And a lot of this is focused more on, I would say, analytics, not actual modeling. So they're just aggregating things up and doing a bunch of reporting and then seeing if whatever the model spit out as a category, which I'll get into here in a second, actually worked or not. And then it's just, just this kind of number games. And I'm going to tell you, it's a ton of work to do a securitization. But let me just dive on in here on these slides. What is the goal of a securitization, right? This is true financial engineering. You'll notice there's a lot of legalese that goes into this. So when you do securitizations, they're quite expensive. You hire out law firms. You tend to hire like a bank to help you. And then you have a rating agency involved. And often you have to do a pitch with multiple rating agencies, especially if it's your first one. But even on subsequent kind of deals here, you're trying to find the best deal possible from the biggest, best name in the business here for your securitization agency. And a securitization agency would be like Moody's or Standards & Poor. Those are kind of the big ones. Other agencies that would be a little bit smaller would be agencies like KBRA, for example. But anyways, there's a lot of work in this, a lot of people involved in this process here. And so as you go through this, right, understanding what the actual goal is of all the different parties and pieces is going to be an important part here. From a modeling perspective, though, the goal is to group loans into some sort of grouping where the loans have similar performance here. And I'm going to hit this multiple times throughout the presentation, but cash flow, cash flow, cash flow. That's really all we're doing here. This is real financial engineering in the sense that we're going to take a bunch of some sort of asset that has cash flows tied to it. So it could be like mortgages, auto loans, motorcycle loans, RV loans, like any type of loan typically is what gets securitized because they have a cash flow tied to that, right? You have a monthly payment that's going to be due with that. Now, big hedge funds, pensions, for example, retirement funds, they're looking to diversify across into like retail loans or different sorts of other assets that are typically harder to access than like big corporate bonds. And so securitization allows you to get access to those markets there. Now, also, you might not want to take a very specific slice of the risk here. So imagine you have, a pool of mortgages. You're going to have customers that are less risky, and you're going to have customers that are really risky. The risk and reward trade-off here, we would expect that you would get more return, more expected return for the higher risk that you're taking on riskier customers. And then really safe, like super prime customers are going to have really low risk. And so you'd expect to get really low return here. Now, when you're doing a hedge fund, a pension, an investment firm of any sorts, you're trying to kind of target different sorts of assets to do portfolio construction and get sort of a exposure to different markets here. Anyways, that process is going to be the securitization of we're taking a pool of loans, we're putting it all together, and then we're going to slice and dice out different types of risks for different types of investors in this process here. And so how we judge the performance of these loans is really going to be looking at cash flows on these. It's all going to be about the groupings, right? Individual loans are hard to track because you'll have payments and it'll default. But is that an outlier? Is that one-off case? Like, what are these sorts of issues? So everything that we do in the securitization is just aggregation and then making sure that pool, that sort of tier that you're going to be tiering out there, whether it's an A, B, C, or it's, 1, 2, 3, it doesn't really matter what you call them, but you're going to have some sort of tier that you're going to tier out. And we're going to assess that based on cumulative net loss and cumulative gross loss, which are going to be these metrics. And I'll draw out here in a second some curves to kind of show you what we're expecting and what we're looking for in this. But the real goal here from a quant model perspective is how do we create categories of loans that perform similarly across time and across vintage here. That's the hard part. It's not trying to get into the accuracy of these loans. You will see when you try to maximize accuracy, when you try to use things that are non-monotonic, so you get things like decision trees that haven't been forced to be monotonic, which I have a paper on this if you want to look at like synthetic weight of evidence. I talk about, doing weight of evidence and how weight of evidence can essentially create that monotonic relationship, and then you can use things like decision trees. But the whole goal of this is really to get loans that are similar in performance into different groups. So for selecting a type of model, there are a few different things you want to consider and look at here. Explainability is absolutely critical. You have to get buy-in from the rating agency. You have to get buy-in from investors as well. So even if you go and you get a deal and it gets through the rating agency, you still have to go on a roadshow and you still have to convince people that they need to buy this loan and these are good products and they will perform as marketed or advertised here, right? But remember, on the backside of all those loans are a bunch of real people that are making real payments on whatever sort of asset they have here. So explainability, getting comfort from the rating agency is important, from banks, from lawyers, from your firm. All these people involved in this process need to understand and trust that whatever has been put on paper is going to continue to perform similar to that. And then also you have a corporate perspective on this, which is going to be different models will tier loans in different types of groups here, right? It's a model, statistical model here that we're going to talk about, machine learning based model. And they're going to move the loans in different pockets. And of course, the aggregation of those loans is going to essentially assume the performance of that. You're going to see how it performs and works. But at the end of the day, like could be infinite number of models you could hypothetically build here to do this. And again, you have to start thinking about how much volume gets put into each of these tiers, right? So if I start to aggregate different loans and I have different numbers of tiers, what is that going to perform like? How much volume is going to be in there? So deals have to be so large. Like I can't run out and say, I've got like $10,000 in loans, let's do a securitization. There's too much risk. The legal fees will eat you alive. You'll have no profit left over from the end of doing the securitization. And you'll want to consider things like price and cash flows as well throughout this, trying to understand which model is going to give you a true realistic expectation, but also which model is giving you the correct number of bins that you want to securitize here, right? I mean, you could hypothetically have a lot of bins, a lot of different tiers and grades. Typically, it's better to keep them simple and short and to the point. Investors don't like to get things that are overly complex. It's a big red warning flag of risk. But start to think about this from a corporate setting of selecting that sort of model. You need to talk to the business side, looking at cash flows and understanding what is going to be the profit from doing the securitization. I also want to mention too, though, like why companies do securitizations, and that's to offload a lot of these loans. And it's a bad word to say offload, but more or less like you have a pool of cash. Let's say you have like $100 million, and then you lend this all out into say like mortgages or auto loans or sheds or RVs or something else, maybe air conditioning units and a home repair. And you lend all this money out. Once you run out, like you don't want to just wait for like a 5 to 7 year period or 10 to 30 year period, depending on the type of asset, to get that money back. You need to keep generating sort of loans. And so what you'll end up doing is you'll end up then packaging all those, securitizing them and selling them to these other investment groups that are wanting exposure for that and getting into those sorts of asset classes here. That provides you cash back so you can continue to do what you're good at, which is actually making loans, not actually just holding them and hoping the investment plays out within this framework here. So from a corporate perspective, this is also a cash flow exercise of I need to get cash back now to be able to kind of float these and make sure I can continue on my core business here. Now, as I mentioned, this is a cash flow problem. I'm going to show you two ways of looking at this, but really it's just cash flow and who the cash is going to and who's all involved in this process here. This is an example from the Chicago Fed. I have the website on the bottom if you're interested in actually like looking at the article and reading more about this. But essentially looking at like a homeowner, right? A homeowner has a house, they need to fund it, so they go to a bank, and once they hit the bank is going to then provide them the loan. So the funding is going to go back to the homeowner so they can purchase the home from like a builder or another homeowner. And then that loan itself is going to be held by the bank. So it's a piece of paper saying they owe, X amount of dollars back for this. That loan is then going to get sold to a third-party intermediary here. And then again, cash is going to go back to the bank. So in this case, the bank being the company doing the securitization, they're going to securitize this. They're going to transfer those loans to a third-party intermediary. They're going to get some funding back on that so they can continue making their loans. Third-party intermediaries is a big, hairy kind of lumping of institutions, finance companies, also put together. So I have on the left here examples of third-party. It could be like a trustee. A trustee actually monitors compliance on the investment contracts of this. So there are obligations like reporting that has to be done so frequently. And there's cash collections and servicing that goes on. So you can see there's a servicer in this that manages the payments and the defaults for the SPV, which is a special purpose vehicle, which is usually what holds all these securitized assets together. And then you have rating agencies, credit enhancement providers, and of course underwriters that are managing the sale and transaction of these to the investors on the other side of that. So there are a lot of people involved in this, but they're all going to be helping to package this through the third third-party intermediary process. Again, those loans then get packaged into a mortgage-backed security, which we have in the bottom right corner here as an MBS. And then finally, bonds are going to be issued for this to the investors. Again, the investors are going to pay some sort of money to hold these assets, and then they will get cash flows back in return. And then also they have a little kind of dotted box here with collateralized debt obligations, and SIVs, which are going to be structured investment vehicles. Sometimes you will have, I don't know what they call them, like second tier, essentially securitizations on this. So like credit default obligations is like people that are now essentially taking a position on the default of these. Anyways, I'm not going to get too much into that. We'll leave that out. That's outside of the realm of standard securitizations here. But essentially the investors are really going to be the last person in this chain here. So these mortgages get packaged, sold, processed, and then back to the investors. And then you'll see as all the payments get made from these consumers or retail in this example, they'll all go back through these people that are making sure the payments are being handled correctly. And then they do the allocation of who gets paid first, second, third, fourth, all the way through the structuring here back to the investors. Another just way to kind of diagram this out and to understand this a little bit differently is, again, you have the borrower, which is like the person that had the house. Again, this is from a textbook on Springer. And then the borrowers send it to the originators. Originators have servicers involved in this process that are collecting payments from the borrower. And then it goes into a special purpose vehicle or an SPV, as we mentioned. And then in this case, it shows kind of those third-party intermediaries helping with this, which is going to be the credit rating agencies giving it some sort of credit, right? It's a B plus or an A or AAA, whatever the rating is for this, into that special purpose vehicle. And then you can do credit enhancements, which I'm not going to cover too much in this video. But examples of this is like you can over collateralize the pool, so there's excess capital in that pool to cover a lot of the losses. You can do cash collateral accounts, which are like reserve funds. There are other things you can do to kind of make this a more enticing kind of deal for investors that might be a little bit worried if it's your first time or if it's kind of a really risky asset. You can do credit enhancement. And then it goes through the underwriting process, which is going to be that whole final, selling it off and marketing it to the investors. And then finally, you have the investors on there that's actually going to be doing that purchase here. The underwriting process is typically done by a different bank from whoever the financial institution is that starts it. They do all the pricing and structuring together. And then again, that gets priced out and then sold out to the investors. So the general way that a securitization works here, as we talked a little bit about, is the financial engineering of slicing and dicing of risk within this pool of loans here. You will typically, like in this example, again, this comes from the Federal Reserve's website as well. They give an example with three kind of tiers here of A, B, and C, where A is the senior tranche, that's the safest. B is subordinate tranche, which is in the middle. And then equity tranche is usually the highest risk portion of this here. You'll notice too in this diagram, to pass through security, they have payments to the investors, understanding this. The losses essentially go from the bottom up. And the way the payments work is all the payments come in from all these loans. It's not like you own a very specific loan. It's a pool. And so that cash flow from that pool of loans gets paid out based on if you're A, B, or C here. So tranche A will get paid first, and then tranche B will get paid, and then finally, whatever's left over at the end gets paid to tranche C here. Now remember, the pricing of this, the highest price that you're going to pay is for A because it's very safe, right? You're almost guaranteed to get a payment, or your probability of getting a payment is just much higher. Whereas when you get down into C, you might be holding like an equity tranche here, and this is going to be high risk situation where you don't pay very much for the cash flows, but you're hoping not too many default and you'll end up with a profit on this sort of end of it. And there's also a concept called first loss. Not everything, so I'm going to put a big disclaimer here. All securitizations are different. They can be customized in a variety of ways and asset types and due dates and structures and tiers and tranches and timings. And there's a whole bunch of things. Securitizations can be customized. So everything I say in here is very generalized. Just keep that in mind. But there's a concept called first loss. Often means the company that's doing the securitization, so the one that has all these assets they're securitizing off, typically take the bottom tranche or a portion of that bottom tranche, meaning they're going to take a bunch of the losses from this sort of pool here. Again, it's, getting some buy-in here. You don't want somebody to securitize a bunch of stuff they know is bad and try and offload it. That is the entire purpose of having a rating agency, right? A third-party kind of due diligence process that goes through like your compliance, your modeling, the credit quality, the performance, looking at the reviews, the analysis, and all that. They're trying to make sure that what is being sold is sold as we understand it and know it and are going through that process here. There are scandals that have happened throughout history, which I won't mention too many names in this, but there are issues where things have gone south, the market's tanked, there's been fraud, for example. And so that's why rating agencies are a critical part to the structure. As long as they do a really good job on the due diligence part, it helps kind of mitigate some of this kind of risk, especially from smaller firms that are doing the securitizations. And as I mentioned, right, cash flow is the goal. Cash flow is king. The entire premise of this is just getting some sort of risk type of cash flow. That's all we're doing with the securitization is I want to buy some sort of asset and I want to have cash flow come off of that. And that is just finance 101. That's what a securitization is doing here. Again, the timing of those cash flows is tied to the risks. You have risk and reward here being played out in the securitization. Now let's dive into the modeling just a little bit. This isn't like let me show you some Python code and some data and some process and modeling. But I want to give you guys a good intuition of what the goal is, what we're doing here, and why this is different than what you would typically do as an operating model for a firm that's, originating loans on the origination side of this. The first big issue is data. Okay, so data is going to be the big hurdle you're going to have to get over. There's an asymmetric information problem here with originating institutions and rating agencies and investors. So when I worked at these big banks, right, or small banks or whatever, financial institutions, fintechs, what ends up happening is you have massive, massive sets of data. So I have all this bureau data. I might have some alternative data sources, for example, on these consumers. And on a origination, pricing, loss modeling side of a firm, I have all this information, all this data, and I'm going to go through and model this out and be as accurate as possible. Again, rank ordering is still critical in the credit space, but you can start to get a lot more granular because you have a lot of data and information on each individual that's going to be getting a loan here. Now, when you go through this with the process of getting rated by a bureau in the banking and everything, you can't use these variables often because the issue is they have no idea how to compare these. And what I'm going to say is we're going to engineer and structure a model so that the model operates as expected by the rating agencies, the investors, and the banks and the lawyers and everyone helping you here, right? The goal here is not to say like, oh, I'm really good and I have the most accurate model, but it doesn't rank order, right? If you said you have A, B, and C tranches, your A tranches better outperform your Bs and your Bs better outperform your Cs. So rating agencies, for example, don't have all this bureau data from this. And so one way that rating agencies go through this process is they're going to compare your deal, your securitization, to historic deals that have been done recently by similar sizes, similar markets, similar assets. And they want to see how they perform to get some sort of like reality check, right? Is this really the, CNLs that we're expecting here or not? I don't know. Let's kind of compare these and look at these and see how they perform and work. So often you're not going to be able to use that sort of data to do that. So what we're going to end up using here is deal structure data. And I know deal structure data is not very predictive, but it is great at doing classification problems of the risk, creating tiers. Again, we're not trying to get like 100 to 1,000 to 2,000 bends. And yes, in pricing strategy, at some of these big firms, there are hundreds to thousands of different sort of pricing tiers and structures and tables that are all designed out to really hone in on supply and demand and the competition associated with originating loans and pricing them out. For securitization, right, we're only going to be doing a few big categories and we want them all to perform the same. And it could be 3, 5, 7, something like that. But what we're going to want to do here is do things like deal structure so that a rating agency and a bank can come through and say, okay, a loan that has this APR and this term looks the same as a loan with an APR and term similar to this other firm. The loss curves looks the same. Therefore, since it's about the same type of asset, the same type of cash flows and everything, and risk associated with this, we can draw out one of these curves and say, okay, that's going to be an expected CNL of like 8% or whatever you're kind of modeling here. Also, when we get into the modeling process, we want to use as much historic data as possible. This has pros and cons. One, this provides stability in your modeling because you have this larger set of data. If you have sparse data, you're going to have really volatile sets of loans here. This is also why when we securitize, it's better to securitize a large pool of loans because you can see the performance is going to be fairly stable because the averages of these data points and everything are going to be really smoothing this out. And we should see an expected performance based on the modeling. Now, the issue with this is strategically firms will change strategies. They might target like super prime and then they're doing super prime and prime. And then they might start to shift and have a different geographic location and dynamics. This makes the data across time not consistent, which is a big issue that we're going to face here with the modeling side of this. But getting as much data as possible to justify this is important, especially for first-time issuers. You need to have enough history to show that these aren't just like randomly picked out of a hat loans and then you're just assigning them categories here. Now, for modeling these, we want to model cash flows, which is challenging here. You can use a variety of frameworks to do this. I will tell you though, often using like default or probability of default modeling here, like a simple logistic regression model, is very helpful to kind of tier these into categories, right? Now, you could model cash flows. Cash flows are much, much harder to model because you have cash flow across all the vintages. And then you have calendar time, which might play into this. And the problem starts to get more and more complex as we start to kind of model things out more granular. And that's why I keep saying like accuracy is nice to have, but grouping them and having consistent performance and rank ordering. So if I say it's an A, B, C, D, E, F tier or whatever, I expect that A has to perform better than B and C and D and all that across time here. So again, pick a simple sort of thing to model to create those groups. Defaults is a critical big impact here on cash flows. You could get this a little more complex and do like prepayment, which is another issue. So you have like competing hazards models. But again, this muddies the water. I try to keep them simple, do something simple like a logistic regression, look at the defaults, set up the timing, the prepayments. When I've done this, I've done a much more complex system with segmentation and bringing all of the prepayments and defaults and full payments all together in a cash flow modeling exercise. But in general, right, the goal is, so just to keep in mind, we're trying to do categories and we just want those categories to be nice and stable across time. Now, as I mentioned, a common approach to this is using logistic regression and using weight of evidence, because weight of evidence is going to force us to have some sort of monotonic relationship, which generates explainability. So a rating agency, a bank, an investor is going to be very, very cautious and not happy with your deal. If, for example, like you have like APR, the higher the APR, the higher the risk, the higher the expected losses. If it's not like a high APR loan has the worst loss performance and the low APR loan has like a wonky, like you have like a relationship that's not linear, they're not going to buy into this. It's like something's wrong with your modeling. Why does term, like how does term react to losses and prepayments? And how does APR interact with this? And how does deal size, for example, like let's say mortgages, you're doing like a, I don't know, sub 150, $150,000 loan, and then like a 150 basically to like 250 and 250. Like if you segment these out, you'd expect that larger loans have a lower probability of default. You'd also expect to see better cash flows on these bigger deals here for a variety of reasons. Anyways, and so that expectation, that explainability piece is going to be required. So engineering that into the model using weight of evidence to help you create that monotonicity in that framework is going to be really, really important to building a stable model here. I will say too, if it's your first time, only create a handful of securitization tiers. When you have limited data, if you create too many tiers, you have sparse data, and one or two loans defaulting might like all of a sudden like blow up like a tier. Like it looks like, oh, it's going to be trending on our average of say like, I don't know, say 18% or something. And then you might see like a spike and you're like at 35% because 3 loans went bad or something. That's not a good thing to do. Having less tiers is often more beneficial. Now, on the flip side of that, if you're a bigger institution and you're wanting to get a better price for different sorts of tiers in the securitization, and also if you're targeting very specific investors at the end of this, like hedge funds and pensions, and you're trying to engineer something for them, you'll want to think about too, like maybe creating more tiers. But again, you typically have larger deals, might be, you know, $1 billion deal, $4 billion deal, something like that for mortgages, getting larger and larger. And you're going to want to securitize and create sort of pockets and make it marketable as a security at the end of it. So keeping that in mind, talking to the business, trying to understand what's the best model to select based on the end use case of this. There's also going to be a part of this where you have to present the model to the rating agencies. You have to present the model often to the bank that's helping you so everyone has transparency what's going on here. Often the model itself will be kept proprietary in the sense of like, I'm not giving you the coefficients and the math equation in the exact way this is done, but you have to be able to explain what type of model you're using, what variables go into that, how those relationships look. And also, they're going to do their own analysis and review of this. So they're going to be looking at the data, plotting, checking, comparing. So you need to have a lot of these things like the weight of evidence and the monotonic relationships within this. But you're going to have to go through a presentation and have some transparency to build trust on this. So keep that in mind as you go through this. It's why I recommend people start with logistic regression. It's just easier and simple to explain. And then, rating agencies understand it, banks understand it, investors understand it as well. And then those WE charts you can use to kind of show the relationships and the designs and why specific loans are getting specific tiers. And then at the bottom here, here's just an example of logistic regression, which is going to be 1 over 1 plus e to the negative x. And then, of course, the negative x section here is going to be that, linear regression, the beta 0 plus beta 1 x1 plus yada, yada, yada. And again, modeling default is a really common way to do this. You could even model default and prepayment, and then you could create some sort of way to categorize them and put them together. But again, the goal of this is to keep it very, very simple and explainable. All right, and then for the results here, there's a few things you have to consider, as I'm kind of hinting at and mentioned in the previous slide as well. Your modeling, your loan performance is going to be compared to other firms here. So again, they're going to take out deal structure variables like asset type, size, APRs, and the credit type and credit quality and a lot of these aspects that we can get, like FICO score, for example. They're going to bring all this together and they're going to take everything you've modeled, presented, and put together, and they're going to compare this now to similar firms in your industry, in your niche, and look at these sorts of assets and try to compare apples to apples and see how the performance is working here. I will tell you, your results cannot vary wildly from everybody else's. So the goal here is not to say like, oh, look, my loans perform 10 times better than everybody else's. The question is like, why? Then you have to explain that why as well. Like, why does your loan with the same APR, the same amount financed, the same underlying asset perform twice as good, has half the losses basically of another comparable loan? Right? It's a red flag of like something's wrong and your model's not working quite well. Again, you're trying to get something that's reliable, consistent, that matches the industry here. I would say often the thing that kills securitizations is people trying to optimize too much, right? We're not trying to optimize here. We're trying to get a fair market value for the securitization. I know this kills management often in the finance departments and the credit strategy teams, but we're trying to get something that is reasonable and comparable. And they will use that and do some sort of comparison here. And so you want to kind of look like everybody else in the sense of your model should perform similarly to the market and to the industry here. The other part of this I'm going to tell you is the reporting side. So this is not the modeling side. This is going to be the reporting, and the reporting piece is huge. It is a massive feat. There are a lot of gray areas, which is why it's helpful to have some sort of bank or company here that's advising you as a consultant on this process, because they can tell you like, okay, this is how the reports get structured. This is how they get put together. One of these is timeliness. Like once you issue a securitization, you have to issue a report on very specific time intervals. And you can't go back and say, oh, oops, the data is not right. Let me change the data. Oh, let me change this part of the data. Because then it seems like you're essentially like fixing and like manipulating and frauding this sort of structure and deal here. So timeliness of the reporting during this whole process, and I'll tell you, it takes quite a while to get a securitization done and put together. And going through this process, you're going to have to keep updating the data as you go. And nobody wants to see that like tiers and losses start to change historically. So that's going to be a key issue here. Now, there are things that are challenging and hard that kind of play into this. If you think about loans, for example, often there'll be like cutoffs. Like we only want to include loans in the securitization that are 60 days past due or less, or 30 days past due or less. So like a month behind, maybe 2 months behind, depending on the definitions, the structuring, and how you put these sorts of deals together here. And as this process goes, right, if you have a loan that goes out of that, so let's say it's like 65 days past due, it gets thrown out, and then it cures and it goes back. You can't have data from like last month that had it included, and then data for this month that has it excluded, and then you have it included again. These sorts of issues and hiccups are a big part of the reporting side of this. Understanding what they count as prepayment and how prepayment is structured. A lot of this is just definitions, legalese, and getting all this dialed in and put together. Once you get it automated, I'm going to tell you, code this out, clean the code, make it simple, make your reporting very, very concise. Even things, for example, like if your firm buys, I don't know, let's say seasoned loans, you will then have weird data counts where like you have pockets where you have like months on book, like 1 to like 6, for example, that have like, I don't know, like say like 10,000 loans. And then all of a sudden you have like 12,000 loans. Like then people are like, why do you have extra loans being added into this? And like, there's a bunch of questions that go along with it, which is fine. But it's trying to explain these and treat them all the same. I will tell you as well, all loans should be securitized and given a rating based on the information you have on that loan at the beginning, at the origination date. You should not be updating tiers. Even if you buy something seasoned, you should not go and say, oh, I'm going to take their FICO score at 6, 12, 18, 24 months into a loan because I'm really smart and I'm going to get more accuracy out of these sorts of deals. That's not what you should do. Everything should be from the origination date because that keeps consistency. And then you don't have like a look ahead bias a little bit because there's some fudging and things that go along. Like you could essentially be like, well, we kind of knew and we updated. And no, you can't do that. Do everything from origination date. That is how your model should operate and function. And then you should be able to go forward and look at that and say, okay, these are tier A, B, C, D, E, F, whatever your tiers are going to be. But overall, the reporting side of this, I tell you, is a challenging piece. I think it's where a lot of companies and firms kind of get hung up here. You typically have your own ways of doing things internally, which work well for you. But as you move into the securitization markets, there's often just kind of industry standards and expectations of how things are reported and how you need to go about kind of fixing those. So having some sort of support firm that can help you through that process is going to be important as they can give you all those details before you get to a securitization agency. And you want to look as good as possible and as competent as possible. So having a lot of these things ironed out beforehand is going to be a big win. All right, so potential issues with this modeling process and the securitization is going to be, as I said, thin data by months unbooked, which causes volatility and unreliable results here. Smaller deals, smaller firms are going to be challenged a lot with doing a securitization because you just have thin data. So as we aggregate these, we will aggregate these based on month on book. Aggregating month on book as that timeline here. If you have pockets that just have thin loans, like let's say, I don't know, your firm's like 4 years old and you're issuing out mortgages at like 10 years, you're only going to have data for the first like 4 years. So you don't even have the tail of that distribution here. The rating agencies, the banks, and everything will try to find a firm similar to you and fit their loss curves and end up using another company's loss curves for you. But again, going through the modeling process helps get you to that point to show them like we are similar, at least in the beginning, and something to fit to. But thin data can create a lot of headaches and a lot of issues here, which is why often it's better to have fewer kind of, tiers or rating systems here in the securitization. Also, thin data by vintage, as I mentioned, again, not having enough history and time. So kind of tying into the months on book, but also if you have things that are like pre-financial crisis and post-financial crisis and like, should you include them and not include them? Those are going to be other issues you're going to run into with these sorts of calculations and aggregations. And as I mentioned, you're going to be needing often historic curves from other sorts of firms and securitizations to kind of help use that. Often they're going to assume the worst. It's just a rating agency, right? They're trying to hedge their risk. They're trying to hedge the risk of the investors and make sure everybody is safe and sound in this process here. Just brace for it. Sometimes you're going to have to take a worse curve, a worse expected loss, just because that's how your curve's going to look like it's fitting, and there's going to be some assumptions made around that. Also, as I mentioned, your tiers are going to have to not cross, and they have to rank order, as we mentioned, across the entire vintage here. So you can't say have a tier A, B, and C, and then your A tiers perform better than B, and then B performs better than C, but only at 72, 120, 200 months or whatever. The curve itself, they don't want to see crossing and weaving back and forth, because then it looks like they should be in the same sort of group. So why don't you just aggregate those together? And then also you start to have questions about why your B tier is outperforming your A tier in specific periods, right? So again, data density, modeling type, all these things are going to come into perspective when you engineer and select a final model. And then briefly here, just talking about reporting and accuracy, and show you guys a chart here. Prepayments, payments, defaults, weighted average life, all these sorts of things are going to come into play on the reporting side of this. And often what these are going to look like is just massive tables, and you'll have different tables for different sorts of loans. But I just wanted to kind of plot out what these things will look like. So you're going to have typically months on book on the bottom, and you'll have from 0 to, I don't know, say, depends on the product, right? Auto loans are typically shorter, mortgages are typically longer. Let's just say it goes up to 84 months on book. And then you'll have essentially some sort of, this might be a CNL chart, and this is going to be percentage loss. And again, it's cumulative. But then you're going to have different sorts of curves that are going to come into play. And let's say this is this is our best one because it has the lowest losses. We have B and we have C in this example. Then you'll have actual data on top of these curves here. So often you might do an exercise of even smoothing the curves out because you might have some thinner data. And you might have, for example, they don't want to see it's a cumulative loss. Now, there are issues where perhaps a loan came in or you purchased a bunch of loans and your volume is not consistent across months on book because you bought seasoned. They don't want to see something like this where like it drops, which it might be like you purchased a bunch of loans that, again, at origination said they were tier A in this case. But those loans have performed so well and we don't have this dot. And one of the reasons you don't do this is because I don't actually know what the performance of all the other loans that were in the securitization performed like. So let's say I bought this from another company. If that other company had like a 80% loss, cumulative loss, and I just picked up the remaining 20%, like it's survivorship bias, right? You don't want to start pricing things out from like this point in time because now your model is going to get wonky and the logic's going to get swapped just wonkily. It's just bad. You don't know what this dotted line is. I mean, that dotted line could look like something like this. And then, right, the remaining loans here, which is going to be this slope, which is this little tiny deviation right here. That's going to be what's then transferred down here if you try to sort of rank and tier out loans partway through like a season deal here. So let's not do that. But often you'll have these sorts of charts built out and then you'll have actuals here. So these are going to be our forecasted, and then you should see actuals that look like something like this, which maybe you come in a little hot, right? You're a little high, and then you start to converge to this line here. But remember, they're cumulative, so they shouldn't be going down unless you're adding and removing loans, which shouldn't be happening for most cases. But you want to see essentially, like I said, like a similar curve to these, and they often won't be exact, but they should look something like this. I mean, even this one might be like low and then come high. But this would be like C hat, this would be like B hat, and this would be like, if you had this one come out, right, this would be like A hat. And it's awesome to see like these two, for example, are performing better because there's a small gap here and a really small gap here at the end. This one's performing worse. That's okay, right? The world changes, the economy changes, but you want like, for example, like let's say your A is 5% CNL, your B is 8% CNL, and your C is like 12% CNL here. You just want to make sure that that performance is fairly consistent across time, across these sorts of things here. Now, also, as I mentioned, there's CNL, there's CGL, which is gross loss. There's going to be like prepayment charts, and they're going to be looking at the percentage of the prepayments. And so there's going to be a lot of these reporting. As I mentioned, you're going to have these like massive tables, and the tables are going to have like actual months. So this might be like months on book, and then this might be like a CNL table. And typically then you'll have like your sorts of tiers. So you have like an A, a B, a C. And anyways, you'll have these big tables, but the months on book part, I guess in this case would be really long. It'd come down here, but they're going to be really, really big tables, and they have to be refreshed consistently. And so they're going to be looking at these sort of CNL charts. And often, as I mentioned, right, you're going to have some sort of performance that comes up to some point, right? It might be a little bit jagged, and then it's just going to stop because your portfolio is not age that much, obviously. That's why you're securitizing it. So you'll have like a historical curve like we saw here with like the green, the purple, and the yellow. And then you'll have some sort of actual performance of where your current pool of loans is sitting. But anyways, I hope you guys found this video helpful. This is definitely not like a how-to video on how to do a securitization, but I want you guys to get the intuition from the quant modeling perspective on how this goes about. We didn't cover things like pricing and how many points you get and like the cost of funds and all that. All these sorts of things playing on the business side of this, but this is more focused on looking at the reporting and modeling side of like how we go about thinking, like how we structure and engineer some sort of model, the data and the variables that go into this. So if you found this video helpful, don't forget to like, share, and subscribe. And as always, until next time.